Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
We're already starting to see this. Individual country agreements. China and Brazil just cut a deal where Brazil would use Chinese currency for raw materials trade, not the U.S. dollar, and any trade back and forth between Brazil and China. There's no reason China can't start replicating this with other countries, and there's no reason why other countries can't start replicating this among themselves, to try and avoid the U.S. dollar. So that's one we're watching, and it's one that's already happened. Again, if this stuff starts to change, if these baskets start to change for global commodities, what else is going to change? Not just in individual country holdings and allocations, not just portfolio allocations from pension funds. You're going to see the central banks have to do a portfolio reallocation. Right now, the dollar's held about 70% of all foreign currencies. About 70% of central bank reserves are denominated in U.S. dollars. Because central banks ultimately have a fiduciary responsibility, if these numbers right here, if currency baskets are utilized for global trade, it means the terms of trade-weighted terms start to change, and then the portfolio shift of the central banks has to start to match that, which means this 70% would start to go down. So you'd not only see selling pressure from individual countries to buy commodities, you'd see selling pressure, you'd see portfolio reallocations around the central banks around the world out of dollars. And needless to say, this stuff all gets to be self-feeding in the market, and sentiment is a big driver of currencies. So one thing kind of leads to another, which leads to another. And as Secretary Taylor said, Undersecretary John Taylor said, we're getting close. It doesn't mean they can't reverse this, but one of the problems we're facing here is because the Fed is now buying Treasury debt, U.S. Treasury debt, in order to suppress interest rates and create more stimulus in the economy, they've put themselves in a bit of a box in that the politicians like the fact that the Fed is buying treasuries in order to stimulate and keep interest rates low. So even though the Fed understands the dangers here, politically their hands may be tied. And when the U.S. starts to gain some traction in the near future, this massive overhang of liquidity, because we're what's called monetizing the debt, when your central bank buys your own country debt, kind of the stuff that goes on in third world countries is what we're doing now, basically. If the Treasury does not step up and mop up these excess reserves like they would normally do in normal times, which these aren't normal times, and we have a very liberal political control at the moment. I won't get into that, but only to say that they seem to, let's not get into that too much, but the Fed may be hamstrung in doing the right thing because of the political process, which means they can't mop this stuff up. So that in and of itself looks like a continued monetization of U.S. debt, which leads to that AAA, which leads to all this stuff, so we're watching it. So that's what I meant when I said the shape of this stuff, the reality of this stuff taking shape, even 2 years ago, was not even in the market. It was the disaster scenario that was out there, but it was just one of those made-up things by newsletter writers that wanted to sell stuff. The reality is these scenarios, these pull the cover over the eye scenarios, are starting to take shape, and you're starting to add some probabilities to it. Not a good thing. So all this happens, as I said earlier, the real GDP, the real gross domestic product of the U.S. would get hammered in a very, very big way. The U.S. is a $13 trillion economy, the big dog on the block. If the U.S. nominal GDP goes to 15 trillion and its dollar goes down 50% in value, guess what? the real GDP, the real productive capacity of the U.S. falls dramatically. Not only that, and this is another trigger here that is very, very important in that symbiotic relationship with China and Japan to a degree. As the U.S. consumer starts to lose wealth because of a decline in the dollar, which can self-feed, the U.S. then goes from number one consumer on the block and may slip to number two or number three. And what does that do in a very big way? If the U.S. consumer status is at risk because of declining real wealth, it means China and Japan no longer need to worry about propping up U.S. Treasury holdings. Why? Because the U.S. consumer is no longer the big dog. They don't have to worry about the U.S. consumer anymore. They're going to shift to someplace else. So we're already seeing we may see this natural process of a rise of the Asian consumer be accelerated because of this. Between the Japan and China, there's estimated 2 to 3 trillion they have in holdings, which would include all those treasuries, and then if you layer in the agency debt we didn't talk about, and you layer in corporate bonds, probably close to $3 trillion. And again, they're not propping up the U.S. consumer and holding this stuff because they like us. They're doing it because it benefits them, because we are the biggest consumer in the world. If that status is changed because of the debt being thrown into the U.S. market, all of a sudden there's not a need to hold these $3 trillion. So you have another massive amount of potential selling pressure here in the U.S. debt markets triggered by that. So ultimately, once we see, and part of this process would be natural, as I said, once we see more balanced consumer growth in Asia, the Asians would no longer need to suppress their currencies because they won't be as dependent on exports, so the competitive advantage of a lower currency has less of a beneficial impact. And also, as we talked about before, it's the flip side. A strong Chinese currency would tend to enrich the purchasing power of Chinese consumers. So as this happens, you're not going to see the Chinese buy treasuries anyway to a degree, because they're not going to need to suppress their currencies, and there's going to be no need because they're going to have their own domestic source of demand. So all these things really start to pressure the U.S. dollar. It doesn't necessarily mean a disaster scenario for the dollar if, as I said, the U.S. does mop up what's out there, and if they allow the U.S. consumer to continue to save and instead of trying to force him to become back into that pattern of consuming. The reason that point is so important, because ultimately, as I said, naturally the Asians, as their consumer demand increases, as they switch to a more consumer economy, are not going to need to hold treasuries. But the pool of potential savings from the U.S. consumer would tend to neutralize the impact of Asia not buying U.S. treasuries. Let me say that again. As the U.S. consumer saves more, it creates a domestic pool of capital. And the savings could go to 10% of GDP. So that alone would be about $1.3 trillion. That would tend to dilute any impact of the Asians not buying new treasuries and selling some treasuries. But again, this all hinges on the fact that the U.S. dollar stays stable and the U.S. consumer wealth doesn't decline. So there's a lot of ifs here, and there's a lot of risk in this. So the consumer plays a big role in what Japan and China do in the future. It's not just purely a pure economic equation, A plus B equals C. All this stuff is tied together and ripples together, and you can see how it self-feeds. All right, all that said, and we'll answer some questions once we get through this.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.